This is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for October 16th of 2023. In getting started with the chart pack this week, we will focus our attention first on the CPI, Consumer Price Index data that was released last week. Much anticipated, obviously, with the Federal Reserve kind of in abeyance on rate increases, kind of waiting on the data. And of course, this is a very big piece of data that we got this past week. You can see here the latest reading, the overall CPI was at 3.7, a little bit hotter than expected. And you can see in that gray line on the chart that it represents a modest uptick from the trough, the interim trough that we have seen here a little bit earlier this year. Core prices, 4.1%, continue to decline. We'll kind of get into the internals there. But really the analysis here is that the overall CPI has witnessed modest upticks in the last three readings. Is it an alarm? No, not necessarily. But we do see core prices continuing their downtrend. All of this to say that we might wind up a lot closer to 3% than 2% when this is all said and done. There are components of inflation that, as we have long known, can be very sticky. And we'll kind of get into shelter, we'll get into wages a little bit, and like I said, we'll get into the internals and kind of dig into this just a little bit. And here we have some data on goods and services CPI. So inflation looking at both the goods sector and service sector, and you can see that they're going in opposite directions. Right now on the goods side, we've had some fairly soft inflation data for quite some time. And we do know that, during the pandemic, we had the supply chain issues, that goods inflation was extremely high at a point where service inflation really hadn't taken root yet. But that has essentially reversed, and service inflation is still pretty high. We see the latest reading was a little bit higher than expected, and tells us that service inflation is here to stay for a while. Now, the read through on this for the Fed is going to be important, in determining, do they wait this out and see this data through, or, are they inclined to push ahead with a rate increase? And we'll talk a little bit later how interest rates have moved up and have really kind of, almost done part of the Fed's job for it. One of the primary components of CPI, and particularly the core CPI, is rents, and more specifically, as it's defined in the CPI, it's owner's equivalent rent of the primary residence. So you can see here these two numbers have come down certainly off of their peaks, but they remain rather sticky and elevated relative to the multi-year trend that existed prior to the pandemic. Now, as we look at this on a year-over-year change basis, the red line is the most important insofar as the CPI is concerned, because this is what is defined as shelter in the CPI. And you can see these numbers are still dramatically high relative to where we know the CPI overall is going. So, even though we've moderated perhaps from the first quarter of this year from 8.2%, now we're 7.2%, you can see that trajectory remains intact relative to the pre-pandemic phase, and so we're just flat elevated in terms of how the shelter CPI is calculated. Now, what's very interesting from Charlie Bolello here is the overlay of the of actual rents that are being paid in the marketplace, and so this is where the divergence from how the shelter is calculated versus what observed rents are in the marketplace, and those now are negative. Now, they were high, and they followed a fairly steep increase in home prices, which is very typical, but that has since moderated, and we're actually negative on rents right now. And I think this is a pretty important figure. So meanwhile, we have the calculated shelter component, and part of this too, understandably, is like hospitality. What you pay for a hotel room, that's pretty elevated. So there's a lot of other things that go into shelter, but just know that one of the critical components of this, that being rents, is actually coming down. Here we have wages, as depicted here by the Atlanta Fed Wage Growth Tracker. It does a really good job with this data series. This goes back to 2005. You can see in the aftermath of the global financial crisis, we were in an upwardly sloping environment for wages leading into the pandemic, and then subsequently with inflation have spiked, but now we're coming off that peak. And like we've said time and time again, I mean, wages are still pretty high, but they're off their peaks, and directionally they are moving lower. Here's something else I wanted to look at with regard to the CPI, and that's the kind of the more near-term trends. And this is where, I'm beginning to wonder if we're going to coalesce around 3% as kind of a long-term target, because I think the Fed does not want to send the economy into recession. In fact, their own forecast doesn't even call really for a recession. There's still a lot of the investment banks have lowered their probability of recession. I think if you poll CEOs, they might feel a little bit differently, but regardless, the Fed does not want to push too hard and make another policy mistake. And so, I think they might be, what you might hear during the coming months is this rhetoric that is kind of suggesting that maybe that neutral rate might be a little bit higher here. So, what's important here, the gray line, the past 3 months. Now, the annualized rate of change in the core consumer price index over the last 3 months is only about 2.6%. So that's a good sign. Now, if you look at the past 6 and 12 months, we've looked at this chart over the last few weeks. It paints a similar story that we're kind of coalescing around this 3%, at least for the time being. Here we have food inflation. We know that that has remained elevated. Again, no surprise here. This goes back to 1980, so it's a long time series that Charlie has put together here. We did have the spike, food at home. We had eggs. We had, you name it, and it was a lot higher. Milk, dairy products, etc. That has moderated. Food at home has definitely come down quite a bit. Food away from home, as we know that consumption has been strong. People have wanted to get out and eat out and be out in the community and whatnot. So and there's other components that go into the food away from home. Obviously, salaries and wages are one. Food costs are certainly another, but those remain a little bit elevated relative to the trend lines. But food away from home beginning to moderate into levels that we would expect over a long period of time. We have mortgages, and we've got car loans, and we've got credit card interest rates. I think this is just a very quick way of showing you just how robust this change has been in the cost of credit all across the spectrum. Now, and this coupled with negative growth in the money supply is a real high calling for an economic slowdown. Now, again, the pundits and a lot of people out there are not expecting a recession. I still think that can be navigated, but it's clear with mortgage rates moving, the 30-year conforming rate there, you see about 7.6. Some people are calling for closer to an 8% mortgage, and obviously that will depend on where the 10-year Treasury goes. But new car loans, you can see that rate moving higher, and obviously on credit card interest rates with a slight uptick in delinquencies in credit card default rates and credit card quality, and those rates are moving higher as well. Here we have bond yields, and this came from the Wall Street Journal. Really good article here and a good depiction, drawing that line a year ago where we were. In some cases, we're really not that much change, maybe slightly higher. 10-year Treasury is certainly case in point there, but you can see this slope, and whether it pertains to corporate credit or certainly high yield credit. We know spreads have been relatively tight. You can see that right here. This whole last 12 months, I mean, we haven't really seen any deterioration in credit spreads, where you'd see that high yield rate move a lot higher than the 10-year. We haven't seen that yet. So again, bond market, especially the high yield market, not necessarily anticipating a recession, but we do see all of these interest rate buckets moving into a higher overall level. Here we have Fed funds and the 10-year Treasury yield. You can see the migration of this to 2015. There's some good data that goes back a lot farther than that. But, when you get to a point where Fed funds is over the 10-year Treasury yield, again, that's our inverted yield curve. But, it connotes a tighter credit situation, as we know from many years, the credit was very easy, and you can see that from 2015 on through really in advance of the pandemic, when we saw the first inversion of the yield curve, and a lot of people forget that. And then the pandemic came along, and everybody basically had to focus on that. But we're at a point now where credit is pretty tight, and we've had a fairly long duration of an inverted yield curve. We'll look at some International Monetary Fund, IMF, data on expected growth forecasts. This is GDP for various areas of the world. You've got the overall global GDP, pretty flat from July to October in terms of the change. So in other words, really no change there. Expecting about 3% overall GDP growth for the globe in 2023. U.S. forecasts have improved a little bit. We've seen better performance overall from an economic standpoint here in the U.S. Eurozone, maybe slightly less so. We know Germany's kind of teetering on a kind of flattish growth situation. And then China, of course, we've been talking about a little bit lately. Overall higher growth rates, but the law of large numbers is beginning to catch up with them. And we do know that that there's a kind of a consumption problem in China that exists right now. We're going to switch and talk about households. We're going to talk about spending. We're going to talk about a lot of different things kind of related to consumption. There's some pretty interesting takeaways here. So as you can see here, going back to 1990, we've got the share of household wealth that is held by the elderly, by adults that are 70 years old and older. And so you don't get this data necessarily on a monthly basis, but you can certainly draw some long-term conclusions that with an aging population and older baby boomers, that you're going to have a greater concentration of wealth. And so when you go from 20 to say like 26%, that's a pretty meaningful number when you think about that the aggregate number being in the trillions. So this is a very meaningful number. Now here we see that particular age cohort on the left-hand side. You've got share of consumer spending by various age groups, and that older age group is spending. Those people generally don't have a debt problem, or not nearly as much debt as the younger generation does. You can see the 25 to 34 rising generation. Those people are the most conservative in terms of their consumer spending. In fact, we've seen negative trends in spending as of late, but we've been buoyed as an economy. Consumption accounts for 2/3 to 70% of the economy, and we're actually being supported in many respects by, I'll call it even the 45 age group and higher, but particularly that the seniors are really helping us out here. And then on the right-hand side, you've got the 12-month change in spending by age group. And again, just to confirm what I've already mentioned, it's that older cohort that is really driving the boat right now. Here we have consumer credit year-over-year change. We do see a deceleration. Credit is obviously getting harder to get. It's getting more expensive, which is a deterrent. If you don't need it, you're generally not going to seek it. Credit growth over the last year was really strong, and we are beginning to see some credit delinquencies kind of emerge. It's not a crisis area yet, but it's something that we need to monitor. But one of the things that manifests out of tighter monetary policy is certainly this, a slowdown in overall credit. Now let's talk about the credit markets, where they're hot and where they're not. We've been talking a lot about how bank lending has become a little bit more difficult. Credit's become a lot tighter. If you overlay the economic growth of the country here on this chart, which goes back to 2010, you'd see a rough correlation between bank loans and the growth of the economy, right? But you've seen a much more pronounced increase in private credit relative to bank loans. And I think that differential will become more acute as we go into the coming year. Banks are getting a lot tighter, and we know that. They're telling us they are. We can kind of see it. We definitely see it in the data. And high yield bonds too have been a little bit flattish. Again, they're issued through primarily the conventional funding channels to borrowers that maybe have a little bit more speculative credit, maybe not as good a financial statement, what have you. But private credit is a completely different animal, and we've seen its evolution over the last decade. Many more players involved in this than there used to be. You've got a lot of the, KKR, you've got Apollo, you've got Ares, you've got a lot of different people that are now in this private credit market raising lots of funds, large funds to do these credit transactions with. And so people are now going outside of the conventional banking sector to this so-called non-bank sector. And this is going to be something we're going to want to talk about. The SEC is trying to get their arms around it with regulation, around disclosures and do investors understand risk and stuff like that. But we'll have to wait and see on all that. But clearly, private credit is going to be something that we're going to want to understand a lot better. And so I've got a few slides coming up which kind of talk to that whole part of the market. So I've got a couple of charts for you here. The upper left-hand side is U.S. bank loans and leases, and you can see, here in 2023 how that's kind of flatlined. And so that's a symptom of a tighter credit environment, which we've talked about. All right, so the conventional banking sector is slowing down its rate of credit growth, and then down below that you see bank loans which are coming due. You've got a lot of different loans that that are issued by banks, generally for borrowers with less advantageous credit, shall we say. And not so much next year, but certainly 25 and 26, we're going to see a lot of maturities there, or at least dates on which there are balloon payments. And so this is going to challenge our system a bit. And I think where a lot of this is going to go, how it's going to be refinanced or refunded, if you will, is going to be through private credit, which you can see on the right-hand side. Assets under management through private credit funds is now about $1.5 trillion. And you can see over the last, call it 15 years, that it's really come from nowhere. And you can see the rate of gain is pretty dramatic. Now, obviously, we've been issuing a lot of business loans at the traditional banking level, but we do know that that's kind of on its way to flattening out, as you can see in the upper left. So you expect private credit funds to really take the baton. So what does this really mean? So private credit funds, again, they're not the traditional banking sector. They don't have, they have, maybe loan committees, but not in the banking sense. And the rates are higher, and the covenants, what you can and can't do while you have these loans, is a lot tighter with the private credit funds. And so the risk being higher, they charge more in interest, and with interest rates already being high, from an investor standpoint, these pools are pretty attractive because they generate high rates of return. To a borrower, it represents a place where they can go to get the credit that they have to have, even though it's going to cost them a lot more money. So we see here in this chart from Bloomberg the expected charge-offs that we're going to have through the traditional banking sector. And so this is contributing to the situation that we have now, where banks are getting tighter on credit and pushing more people into that non-bank sector that we just kind of described for you. And you can see the evolution here by quarter is moving higher. So this correlates to the bankruptcy filings that we saw, and notably on the part of some larger organizations, which, when you get bankruptcies, for companies that employ, 10, 20, 30,000 people, you tend to take note. And but be that as it may, here we have estimated charge-offs continuing to move higher. So before we leave the topic of private loans, private credit, I'll offer you a couple more data points here. And on the left-hand side, we actually have average rates for bank loans and private loans. You can see the spread right now is about 3 percentage points, but it's typically a lot wider. And I think it is going to get a lot wider because banks are pulling out, so there's still a demand for credit. And then if private loans are going to fill the void, then they're going to be able to charge more. And so I think that spread is on its way to kind of widening out again. But you can see here, overall rates are kind of in that 12, 13% range, which is about 5 percentage points higher than what you would typically see on a bank loan. But even those are moving a little bit higher because of the tightening credit. So they're pushing closer to 10%. On the right-hand side, you've got a lot of these bank loans already have been converted into private debt, and more so this year. Do not have any estimated figures for 2024 in this data series, but I would hazard that number is going to continue to rise as you have more of these maturities or balloon payments, for people that have loans with banks that are not willing to refinance. Get into some general economic data. Here we have office construction for the Austin metro area, our own backyard. An interesting dynamic now. We've been talking a lot about like the coast, San Francisco and the East Coast, where vacancies are picking up, but the vast irony that I really just absorbed this past week in the article that these charts came from in the Wall Street Journal was that there's been so much construction in Texas, in these major markets, Houston, Austin, Dallas. You see the Austin numbers right here in those bars. We've had so much construction that despite the influx of new entrants and the relocations of businesses and workers, et cetera, that we actually have a pretty high office vacancy rate. In fact, Houston is now the tops in the country at about 27-ish%. And the fact is that with credit being very inexpensive and a lot of people understanding the Texas growth story and understanding this argument about people that want to relocate here and whatever, that we've built a lot of speculative offices. And now with the pandemic and this future of office kind of like playing out before our eyes, you've got these major metro areas that have a lot of vacant office space in there, and we're apt to see lenders become even more persnickety on office projects here going forward. So another one of our high frequency indicators is the TSA checkpoint data. So we know We already talked about consumption being a lot stronger than folks expected this year. That represents, 2/3 to 70% of the economy. Discretionary spending being a component of that, as well as retail sales. We can see here that people are on the move. They're traveling. The black line represents 2023, and it has been consistently above the 2019 line for a few months now. And this is interesting because all throughout the pandemic, when I talked about these high frequency indicators, I always kind of weighed the current environment against 2019 because that was the last full year that we had before the pandemic. And now that we've eclipsed that, it's clear that at least the consumption, leisure, and a lot of these elements that were just completely decimated during the pandemic are, back to above the levels that they were that they enjoyed before that shutdown. Another one of these high frequency indicators that we've been talking about throughout the last several years has been containerized freight pricing. And we noted last year that those prices were coming down pretty precipitously, and they've remained very steady throughout 2023, which good and bad news. Good, obviously, if you're a shipper, retailer, you've got to bring product to market, and these containers are pretty cheap now relative to where they were just 18 months ago. The bad news is for the shippers themselves, and so some of the supply has actually been taken off the market because some of these rates are so low that they are not profitable. And so, I think container shipping prices are apt to maybe move a little bit higher just in an effort to find equilibrium. But I wouldn't expect them to go back to areas that they were previously. But, I do think container pricing will moderate here some in the coming year. On this slide, we have corporate bankruptcy filings. These are large firms. You can see the trend is up. This is very symptomatic of a slowing economy. We've shown you this kind of data at least 2-3 times over the last several months. So, it's not a surprise here, but, it's just another confirmation of the impact of higher rates on hiring, the impact of higher rates on some profits, although as we'll see here in a moment, earnings estimates and profit margin estimates for companies are expected to improve next year. So this is a pretty important slide as we kind of transition into the investment markets. And in the gray line, you've got the S&P 500 earnings yield over the next 12 months. And green line, you've got the yield on the 10-year Treasury. We know that that's been moving higher. And so, when you make the arguments for, where there's value in the market, where the markets are attractive, obviously, if you're looking for, growth, you look at the equity market because you get a higher earnings yield than you can on the 10-year Treasury. And so that is the kind of the risk premium that you receive by investing in equities. Well, right now that risk premium is very nil. You can see those two data series almost kind of converging. And so right now bonds are a lot more attractive relative to stocks, and with the interest rates moving higher, this is exactly why we've had some stress in the equity markets over the last couple of months. And you can see that equity, that risk premium has narrowed consistently, this year, particularly over the last several months. And so it was just a matter of time before this really caught up with us. Now, question is how high are yields going to go? We don't quite know yet. And obviously, if we have a little bit of a sell-off, perhaps, particularly in these high-flying, artificial intelligence stocks, and we've got a slide on that too. But if that stalls out a little bit and prices moderate somehow, then this number gets a little bit back closer to normal. But right now, the convergence of these two data series is, provides a lot of explanatory power on why the equity markets are a little bit stressed right now. We have a chart showing us that we have moved into rarefied air with regard to the inverted yield curve, and this goes back to 1969. And honestly, we've not had this many consecutive days before of an inverted yield curve. Now, good news is with long-term rates and the term premium expanding, that this is becoming less inverted, but it still is inverted. And so if you look at the impact on the economy, I think we see it manifesting in slower overall growth. We just saw bankruptcies moving up. We saw credit tightening, so on and so forth. And I think that's going to continue. Again, the risk is that we have a recession. Can we manage a slowdown? And there's a lot of things that we have yet to really understand right now. Obviously, Fed is kind of sitting on its hands right now. They're letting the bond markets and higher interest rates do a lot of the work for it. But we don't want the Fed to act too much and kind of basically engineer a slowdown by increasing short-term rates over longer-term rates. But at the same time, we don't want to reintroduce inflation into the forecast. And that's where we started this broadcast with, inflation maybe not moving down as fast as folks had thought. And so, there's a lot of known unknowns right now. And so that's why there's a little bit more volatility in the equity markets. Here we have S&P 500. Looking at it a few different ways, we've got the number of stocks here in the upper left that are trading above its 50-day moving average. That number looked a lot worse about a week or so ago, a couple weeks ago. Picked up a little bit, but it's still pretty low at 25. You can see how that oscillates over time. This is going back, basically about a year or so ago, 15 months, but it's still pretty low. So we've got a lot of stocks that are trading below their moving averages. Now, down below that, you've got the number of stocks hitting new 52-week lows has picked up a little bit. So again, this is evidence of the stress that we've seen in the investment markets. And then, for more of a kind of a pure technical indicator on the right-hand side here, we've got the S&P 500 index relative to its 200-day moving average. So again, longer term average tends to smooth out the variations a little bit more. And from a technical standpoint, you like to trade above that, or you like to be below it, but then passing through it on the upside. Those are generally, positive indicators. But we've gotten close to testing that 200-day moving average before we began to kind of like surge ahead a little bit. But it'll be very interesting, amidst the backdrop of, geopolitical tensions, which, honestly, we haven't talked about Israel and Gaza much, but, we'll obviously be keeping a close eye on developments there. But, we'll be watching this technical indicator because we want to continue to stay above it. Here we have the impact of the so-called Magnificent Seven. These seven stocks in the S&P 500 account for over 30% of the entire market value of the index. That's profound, considering that there is literally about 500 stocks in the index, and seven of them account for basically a third of the index. So, what that does is it makes the S&P 500 a very difficult benchmark to use, because you've got the rest of that market, or the equal weighted version of the S&P 500, that's trading frankly a lot lower than the overall index, and it's trading a little bit more in line with the Dow Jones Industrials and some of these other benchmarks. But you can see that the Magnificent Seven, we've got Google, Microsoft, et cetera. These are technology stocks. You can see that technology valuations are high. They're currently resting about 25, 26 times. Their longer term average is around 18. So they are stretched. And so when I think about the volatility in the market, where does it come from? It could easily come from a moderation in price to earnings multiples on the part of these technology stocks. And if that happens, then we will see a little bit of stress in the S&P 500, probably more so relative to, say, the Dow Jones Industrials. We have yearly performance of the overall index relative to the equal weighted index, which is what I was just talking about. So not too surprisingly, in the last data point here on the far right, you see that the all-in index that is dominated by these magnificent 7 stocks has tremendously outperformed the equal weighted index. But you can see here that when you have stresses in the market, 2000 through 2003, and then again in 2008 and 2009, that the equal weighted index really outperforms. And that is a lot of where we're aligned here when the goings get tough in the market and in the economy and the froth is taken off of these technology stocks. You don't want to be disproportionately exposed to them. Here we have a bearish, bullish sentiment indicator, and we are definitely in a bearish sentiment territory. And oftentimes this is kind of a contrarian indicator because usually the markets will go up after this, after you hit a trough in bear sentiment, and that is exactly where we are right now. And I think a few people have identified, our current valuation, et cetera, in a lot of parts of the market as being kind of oversold. And I tend to agree on a short-term basis. We're probably oversold. Obviously, if we hit a kind of an economic downturn, then I wouldn't expect multiples, price to earnings multiples to blow out. But right now, at least by this indicator, when sentiment is pretty weak, that's usually a good time to buy. Here we have corporate profits. As I mentioned earlier, we're expecting those to increase. Again, this is something that I honestly don't want to get too carried away with because these can obviously be revised down. But honestly, if you're looking out onto the horizon, looking out into 2024, you probably should feel a little bit optimistic. Here you've got quarterly profit growth, and then the estimates looking out to 24 that on the Bloomberg data on the left, those are positive and positive, not just like 1 or 2%, but I mean we're talking in the second quarter we're talking about 12, 13%. You can see that on the right hand side there with those estimates that are in the amber colors moving higher. So even as we have had a earnings recession. Let's be clear that earnings have been negative for about 3 quarters now, but this should be the last one that they're negative. And then fourth quarter, they're actually looking for 6 to 7%, and then that gets only higher next year. And here's another look at that earnings estimate track. You can see the consensus now, again, for positive earnings for Q3. I think it's debatable whether we're kind of flat or maybe even slightly up, but this is really expected to be the last kind of materially weak earnings quarter before before things begin to tail up. And again, you see that depicted. Here on the upper part of this chart, which is the all-in EPS, and then if you back out energy, then you see even higher rates of year-over-year growth. That's all we've got this week. Hope you've enjoyed the charts. Have a great week, and we'll talk to you very soon. Bye-bye.